Hi, welcome back to CBSE Board Economics. I'm Saddam Hussain. We're carrying on with the banking unit. We have seen Reserve Bank of India, its functions, commercial bank, and we've seen that RBI's functions broadly can be classified into 5 categories, which are these. Number 1, currency authority. Number 2, banker of the government. Number 3, banker's bank. Number 4, lender of the last resort. Number 5, custodian of the foreign exchange. Number 6, monetary policy, credit control, policy. We have already discussed all the other functions in detail. Now in this video, we will be discussing about control of money supply and credit. That's a monetary policy of the central bank. Of course, we'll be discussing all these points in detail. We won't be able to discuss all these in one video or one class because they become too lengthy. We'll discuss all these in parts. Now let's discuss broadly what exactly is monetary policy. The most important function of the central bank is monetary policy. What exactly is monetary policy? Monetary policy means money supply and credit control and credit expansion policy. That means the central bank decides how much money supply should be there in the economy. The central bank decides whether there should be more money supply and less money supply in the economy, depending upon the economic situation. If there is excess demand in the economy or inflationary gap, the central bank tries to reduce the money supply. If there is depression or recession in the economy or deflationary gap or deficient demand, the central bank tries to increase the money supply in the economy so that it will increase the aggregate demand in the economy, so that the economy's employment, output, income, everything will go up. So that's monetary policy, money supply and credit control and credit expansion. Control and expansion, credit. That means the commercial banks give credit. So sometimes the central bank wants that the credit should be expanded, sometimes the credit should be contracted. When the central bank wants the credit should be contracted, when there is excess demand or inflationary gap in the economy, the central bank tries to control the credit. When there is depression in the economy or recession in the economy or deflationary gap or deficient demand, the central bank tries to expand the credit. So that's basically monetary policy. Monetary policy is central bank's money supply and credit control. That's a monetary policy. Control of money supply and credit. How does the central bank control money supply and credit? There are many instruments, or we call them as many measures. All the instruments available to the central bank to control credit and money supply in the economy, we can classify them under 2 headings or 2 categories. One, we call them as quantitative instruments. Quantitative means the amount of credit. Quantitative, we should give more credit or less credit. Quantitative instruments. Again, under quantitative instruments, we have 3. One is bank rate, interest rate, repo rate, reverse repo rate. These things we'll be discussing when we talk about bank rate in detail. Bank rate, interest rate, repo rate, reverse repo rate. All these we'll be discussing. Then you have open market operations. Open market operations means buying and selling of government securities by the central bank to the commercial banks and the public. We'll be discussing about it later in detail. The third one, varying reserve requirements. Varying reserve requirements. Under this you have 2 things. One is cash reserve ratio. We call it as CRR. And the next one, statutory liquidity ratio, SLR. We'll be discussing these also in detail, CRR and SLR. So you have under quantitative instruments 3, bank rate, open market operations and varying reserve ratios. Then you have qualitative instruments. Qualitative means you have to see the loans which are going into the economy, for which purpose they are used. That is direction of change. Are they being utilized for production or for increasing output in the economy, for increasing employment, for increasing income? Are they utilized for speculation? That is qualitative instruments. That is direction of change. Under qualitative instruments, you have margin requirements. We'll be discussing it later. And then you have moral suasion. Moral suasion, of course, we'll later. Selective credit control or direct action. Selective credit control, direct action. I repeat once again, all the topics we'll discuss in detail. We are discussing the last function of the central bank, which is the most important function of the central bank. We call it as monetary policy or money supply and credit control. What is monetary policy? Monetary policy is the central bank's money supply and credit control policy or credit expansion policy. Under monetary policy, the central bank uses 2 instruments. One is quantitative instruments, the second one is qualitative instruments. Quantitative means the quantity of credit, and qualitative means direction of change in the credit. Under quantitative instruments, we have 3 sub measures. One is bank rate. So synonymous to this, we have repo rate, reverse repo rate and interest rate. The second one, you have cash reserve ratio, and that is cash CRR, and statutory liquidity ratio, SLR. So then you have the last one, open market operations, bank rate, open market operations and varying reserve ratios. Under this you have cash reserve ratio and statutory liquidity ratio. Under qualitative instruments, you have, qualitative means direction of change, whether the loans given by the commercial banks are being utilized for productive purposes or not. Under this you have the first one, margin requirements, moral suasion and selective credit control or direct action. So we discuss once again, monetary policy is the central bank's money supply and credit control. Under this you have 2 instruments, quantitative and qualitative instruments. Under quantitative again you have 3, bank rate, varying reserve ratios and open market operations. Under qualitative instruments you have margin requirements, moral suasion and selective credit control. Don't forget to watch the next videos. So we'll be discussing all this in detail one by one, because they need a lot of points, so we won't be able to put all these in one video. That's all we have time for this video. Till we meet next time, it's goodbye. For I was saying, right, work hard for the exams. Till we meet next time, bye bye.